Well, investing the Templeton way was really a research project that we did at our company. And then we had the opportunity to turn it into a book. But what we decided to do is research some of his well-known trades throughout his career. And what I wanted was the historical context that the trade occurred. We read all of his letters and reports surrounding those trades. I really wanted to put myself in the frame of mind where I understood the context for his investment decision. And so what the book does is profile 10 of his most famous trades and puts those trades into historical context. So for instance, we talk about his famous first trade, buying at the point of maximum pessimism, where he invested $10,000 on the eve of World War II in 104 companies trading on U.S. stock exchanges. 37 were in bankruptcy at the time. And ultimately, all of those companies were profitable except for 4, and he turned the $10,000 into $40,000. But we wanted to look at why he made those decisions. What people don't know about that trade is that he was actually investing in high-cost operators, which is something most people would never imagine.
That's right. I mean, most often he would go for quality, akin to Warren Buffett or any other value investor. But in that specific situation, he was flexible enough to look at the simple fact that those were the best bargains at the time. And part of that reason was he was looking for the economic benefits of World War II, the rise in industrial production, and the effect that would have on the highest cost operators in the market who were near or in bankruptcy. And the second factor was if you had gone out and bought the high quality firms that had continuously made profits through the 30s, a lot of their profits would have been clipped by the excess tax on wartime profits. And these firms that had been generating losses had the loss carry forwards and were never affected by that. So those were the stocks that stood to benefit the most. So it was that flexibility to look at that specific situation and find the best bargain that I think was key. And he just demonstrated it over and over again throughout his career. I mean, he was a global investor, but if you look at 1982, for instance, the death of equities period, when no one would touch U.S. stocks, he had nearly 70% of the Templeton Growth Fund in those stocks, U.S.-based companies, because they were the best bargains on replacement value. So he was always flexible enough to just go and find that bargain wherever it was.
Yeah, and we have chapters on his investments in Japan in the 40s and 50s, and in South Korea post the Asian financial crisis. And reading and researching those chapters, we saw what he saw in Japan, what he saw in South Korea, so that now we will be able to identify that in other countries during our investment lifetimes. I mean, his investments in Japan in the 40s and 50s were so early. There were capital controls. You couldn't convert the yen to the dollar. He was confident that those capital controls would be reduced. Eventually, he was confident enough to start investing his client money into Japan. But he was very early there, and he saw a lot of the same characteristics that he saw in Japan. He saw in South Korea, and it enabled him to invest in South Korea on the heels of the Asian financial crisis. So I think investors can learn a lot by reading about his historical trades. It is an interesting book.
Yeah. Now I would say in the present day, Sir John rode the Japanese phenomenon for 30 years in this fund, and we look at the emerging market consumer today in a similar light. We're content to, continue to exploit this theme over the next 20, 30 years because it probably has that much firepower behind it, even notwithstanding cyclical collapses like the real estate bubble in China and so on and so on. So we'll try to seek to take advantage of volatility as it occurs in those probable events over time.